Our next panel discussion is Financing Climate Innovation, the rise of non-dilutive capital and its impact on future climate tech funding. That's what our speakers will be tackling next. So please welcome Christian Jolk, co-founder and partner of 2150. David Janashvili, Managing Director, Climate Tech Investment Banking. Rachel Slabaugh, partner at DCVC. And our wonderful moderator moderating this panel, Alberto Toril, advisor at Clean Tech for Iberia.
Hello, everyone. Thank you for joining us in this conversation right after the lunch break. I hope you don't hear your Spanish colleagues explaining you about what siesta means in Spain. We are going to energize you with this vibrant discussion so you don't fall asleep. It is a pleasure to be with you. Again, I'm Alberto. I represent Clean Tech for Iberia. That it is an initiative that it is working to make the Southern Europe region a powerhouse of clean tech by connecting investors, innovators with key decision makers. Today, we will be discussing about non-dilutive capital, but as a context, brief context, the landscape about the non-dilutive capital, we are seeing that it is shifting. On the US side of things, we see the policy environment is quickly shifting, and we will have the chance to discuss about how the new administration actually is, reflecting on some of these institutions and programs that were in place, and that, they are changing the role on the way that they are operating. In the European side, we are seeing a mix of ambition, but as well constraints happening. But despite this growing pressure, opportunities remain, especially for those funders and investors that are able to navigate this type of new financial structures, navigate the risks, and be able to make and to reach the agreements that are necessary. So, as we know by heart, traditionally, clean tech startups has been funded through equity rounds, and this is where venture capital plays a central role. But this model is increasingly stretched, right? Especially for startups and investors and innovators that are working on technologies that require large upfront investment, that require long development timelines, that brings high industrial risks alongside. And particularly in Europe, where we are seeing companies that are looking for alternatives to avoid excessive dilutions. We are looking to the first of a kind projects, and as well attracting institutional capital in the context. So as I said, today we will dive in the role of how non-dilutive capital, things such as venture debt, blended finance, we will talk about public-private guarantees, we will talk about offtake agreements, and so on. And we will discuss how these can help climate technologies growth without putting under pressure investors or funders. So we will explore in the panel how these instruments are evolving, how they complement private equity, and how they can help economies to remain competitive while scaling clean tech innovation. We have our great panelists today. They've been already introduced, but perhaps, I would like to start, with a framing question to all of you. We will start perhaps by you, Christian. Pretty much we want to know what you do on your institution. What particularly you focus on, but as well, as we discussed, particularly on non-dilutive capital. What do you think is driving this shift toward growing momentum on non-dilutive? What's changed recently, and what should we expecting, especially in this evolving geopolitical context? Basically, how do you look at it from your investor cap?
That's a lot of questions in one go. But let's start by just saying, it changes every day. People are reading the media, right? So this is changing every day. I think if you look at it from a more long-term perspective, the way we think about it is that the category where we now have to invest in hard tech is basically driving this shift of capital. I think when you look at the world, there's plenty of capital out there, right? So even if we see that some of the programs on non-dilutive financing are changing and maybe disappearing, I think people need to be reluctant to basically move away from it, but rather just think of it as the capital is moving in its way to another capital stack. So the capital is still there. That's my key point, right? And we just need to find other ways to actually communicate around it. And I think we're seeing the market moving into become more commercial, as we saw with wind and solar and so on, where subsidies have changed. So I think it's going to change day by day. From now, we're only 5-6% into Trump's period, right? So that's just how it is. And I think the European Commission is also moving forward with their initiative. So lots of things to just hang on to for now. But I think the most important thing is capital is still out there, so don't lose the motivation.
That's great. So the capital is there. David, how do you see from your investment banking expertise experience?
Yeah, thanks. Yeah, it's a big question. I think it's a bit of a fallacy to start to keep thinking about these things as homogeneous asset classes, like a first of a kind, et cetera. You have to actually, I think, be very discerning in a way that you define various risks. We're talking about innovation as a whole. We're talking about multitude of different verticals that make up clean tech, climate tech. And ultimately, I think we're talking about very different types of risks. I mean, innovation means creative destruction. In most cases, these companies are stood up to then sell into existing value chains. In many cases, these value chains are global oligopolies. I'm shocked at how often people seem to disregard kind of this big question of how in the next 10 years are you going to fit into a global environment that already exists, whether it's a simple type of technology like cement or something as complicated as sustainable aviation fuel or nuclear or any of that. But I think to your point, I fully agree. The capital is there. The capital is not homogeneous, much like risks are not homogeneous. I think it's incredibly important to be able to define the risks that you're facing, to figure out ways that can be that those risks can be mitigated. What are some of the things that you actually as a management team need help with? I actually think, like, listen, I'm going to plug the industry. I think bankers as a whole have been coming a long way with the help of project finance, with the help of corporate bankers as well, in trying to help the management teams think through these things a little bit more creatively. Like, capital is there, but it's not just there. You have to know exactly types of things you want to insulate against and then try and design creatively products that will be able to fix those.
That's amazing, and I love innovation means creative destruction. We will pick it up on the risks later on. But first of all, Rachel, over to you. How do you see this landscape of non-dilutive funding evolving, and as well, how do you see from your investor cap at DCVC?
Yeah, and for those of you who don't know, DCVC is a deep tech venture capital firm. We invest in a whole lot of sectors, but climate specifically, from pre-seed up through sort of Series B and beyond, and I focus on climate. So we've seen a lot of shifting in the focus of non-dilutive capital over, I mean, not even just the last few months where everything's gotten very chaotic, but we think about Clean Tech 1.0. One of the big lessons was people were trying to build these really big capital-intensive projects with equity dollars, and that just was never going to make sense from a returns perspective. And so this time around, we've seen a lot more institutions start to think about what are the finance vehicles that are going to make sense. And so I think that ecosystem has started to flesh out more and is growing. And to what has already been said, the money is out there, and they're in different pools and different buckets, and some of how that's working is shifting. I think certainly on the US side, there was a lot of sort of grant money for more early and mid-stage, and that's perhaps drying up a bit. But the thing that is consistent is at the later stages, when we're talking more about project finance, infrastructure, good companies have been able to get funded before, and good companies are going to continue to get funded. And so I think a lot of the focus is really on, do you have good fundamentals? Are you building a business that makes sense in a unit economic standpoint in a market that is large? And I know we're going to talk more about sort of commercial agreements and traction. Do you have the commercial traction that makes sense? So I think we're going to see more rigor in some of those criteria for good businesses, and perhaps a little less irrationality about the flavor of the day, but we'll see.
So perhaps to follow on, so we have this puzzle with different pieces, either if it's on the supply side, of course the finance, the demand. So picking up on the contracting side of things that you were mentioning on the offtake side, we heard often about offtake agreements, PPAs, concessional loans, but what actually works? I mean, how non-dilutive agreements should be structured there to mitigate, and we talk about risk, if it's a market risk, if it's a financial risk, if it's an execution risk, to get those risk heads. I mean, how these agreement side of things works?
Yeah, it's going to depend a lot. I mean, and David can talk about this as well, where you are in your risk trajectory. So if you're early stage, you can't get non-dilutive capital from a bank on an LOI or an MOU, but maybe you can get some agreements that are with some more flexible or concessionary capital where there's evidence of commercial traction, but it's not firm yet. But as you go to more risk-averse forms of capital, you need firmer and firmer commitments. So if you're talking about project finance, you need offtake agreements probably that are take or pay, or at least pretty rigorously papered. In the energy sector, power purchase agreements, people know what those are, they know what to do with them. Some of the challenges we see with these new technologies are in industries where they haven't had those kinds of agreements before. Mm-hmm. And so you're inventing them for the first time, and then some of the more risk-averse groups don't totally know how to think about them. So I think one of the opportunities in the industry is to really bring rigor into those new agreements or find workarounds.
Mm-hmm. That's super interesting, Kristen. I would like to as well hear from your side, and as well, on the portfolio that you may have, perhaps there are some examples of companies hedging those risks through contracts, like a little bit of like, how do you see?
Yeah, I think when we look at our portfolio, so for every euro that we basically invest or dollar, we can actually raise 73 cents on the dollar or euro of non-dilutive financing. So we see this as very successful, right? And I think these are the metrics that we need to start sharing, that's actually doable. I think also to Rachel's point, there's something about the maturity across industries where the energy sector has been thinking very long term for a lot of years. The other industries have not, and I think we have not found the magic bullet to basically find that hedging. But I think it's about bringing the industry participants together, and then I think it's very much a product of the fact that the capital stack has not really formalized yet. It's like we are in a transition journey, and unfortunately that is not one where all participants can change, as we maybe save Silicon Valley Bank or something else like in a few days. But it's something that takes probably, a few years. And I think that is the risk that as a startup, as an investor, we have 2 or 3 years at least where this uncertainty is there, right? And on top of that, the political risk. So that's just too bad, and that's the survival time, I think, until we get that capital stack in place.
I think one other thing is I think it's also very difficult to think of PPAs and offtake in isolation from execution and production. You can have an ironclad PPA with a investment grade offtaker, but it's still going to be, if you're a battery recycler, you're going to be subject to yields. You're going to get a certain type of batteries coming in, and you have to guarantee a certain type of yield on lithium, cobalt, whatever it is that you're extracting. And I think that those are incredibly difficult. So like from a true project finance bank product, PPAs aren't the only thing that matter. It's actually the longevity, being able to demonstrate that you're able to deliver. And that's, I think, where concessionary angles around non-dilutive capital have to come into play. There are great government programs historically, like, Canada Growth Fund, and in the US as well, where there were bridges set up for first-of-a-kind type projects to demonstrate that you can actually get there, and then next project you can actually get more from banks. But unfortunately, those are drying up. So the question is, how can you entice really the private pockets of capital, which exist absolutely, to step in?
Definitely. So it is not only, so it's levelizing the different elements that you need to put in place. Either if it's on the front or the back side of the train, but it is making sure that risks are understood, and well allocated throughout that train. We mentioned as well maturity states of the companies, right? And particularly for non-dilutive capital, where, Rachel, do you think it is the right moment for a founder to look at this type of instrument? Perhaps when it goes too early, might be too early to distract, from other stuff. When it's perhaps too late, might be, a moment where you lose the window of opportunity. Where is the sweet spot for non-dilutive funding? Yeah,
it depends on what type of non-dilutive funding. So if we're talking about like a project finance, you don't want to go before, for example, you can demonstrate that your process works the way that you want, because then you either end up in a situation where you can't deliver the thing that you said, and now maybe you lose your company because there are financial penalties, or you have to take such terrible terms that it will never make sense. And so it's not exactly a too early, too late overall. It's being at the right level for the product that you're going for. I mean, if you take grants, grants early in the stage of a company are great, but as you get farther along, they can be burdensome to comply with, and then there may be not enough money to be worthwhile, right? So that's kind of you just need to be at the right stage for the risk-reward trade-off.
The risk-reward trade-off. And we hear that often as well, no? That depending on where the moment you are growing, no? I mean, it would make more sense actually to give some of those grants on the demand side of things. So like, customers can hire your technology and as well helping you on industrializing, standardizing, reducing your CapEx, no? Not just with an upfront grant concession to your project, right? So there is a structure that it is evolving, right? I would like to now pick it up on the concept of the capital stack that you were mentioning, Christian. I will pose the question to you, but I would like as well to hear from David on how to reflect on that, right? We mentioned that there's global programs might be shifting. We mentioned, we know the IRA, we know, how, ARPA-E, how, things are changing, in the US, but affecting the global scale. And this is where we might be seeing more regional or local players coming in, often with more flexibility on the public side of things. I would like to delve into how the public sector can help on building that capital stack, right? How do we rethink the capital stack from public to private, Christian? How do we mobilize the capital that already exists, but isn't flowing where it is needed?
So I think that we fundamentally need to change the narrative around non-dilutive financing into figuring out how we create productivity. I think there is no doubt about that some of the non-dilutive financing that has come out in the US has been very successful actually, and it's been too slow in Europe. So I actually think non-dilutive financing from the government public side can really work when it's really focused on productivity as well, and not just sprayed very broadly. So that's something where you could argue that everyone here in the room, whether you're a founder or whether you're an investor or elsewise, product market fit, and I think that comes back to what you mentioned, the different products needs to find their product market fit. I still think we have some way to go on the public side because we have a turmoil on all public institutions. I think the banks, are quasi public because you think of that as an infrastructure layer in the society. So I actually think that those are probably the ones that short term can provide most non-dilutive financing until we get more clarity both from a European level on how many countries will work together, in US, how many, will still be funded from the IRA and other pockets. So I think those are the ones who should step up now, if you ask me. And then we have to see how we make the public funding work over time and get it more speedy and faster.
Yeah, I absolutely agree with you. I think many of the US programs have been remarkably successful. Title 17, ATVM, AFWorks for the Department of Defense, the Department of Agriculture programs, very successful. We talk about very low default rates and standing up massive global value chains and industries, including the likes of Tesla and EV charging and things like that. Phenomenal success. Again, there's a lot of politics, and obviously we're all aware of that. One other thing is, I think on the private side, there's clearly lots of emerging groups of capital. There's an argument to be made that if you're a tech company and you're trading at a 50 times price to earnings ratio, your cost of equity is 2% implied, you have free money, you should be just investing everywhere. And some folks are doing that, like Google used to have the Google X, right? The program with the moonshots, et cetera, that's no longer around. And I think now we see that spilling over into nuclear, where all these large, and data centers, where all these large tech companies are kind of looks like frivolously putting in billions of dollars into these startups that may or may not succeed, but it's all in the back of incredibly cheap capital. I don't think that's necessarily right, because the shareholders of those companies are not necessarily putting money in because they're not giving them the mandate to deploy this capital. But there are, the Creo Syndicate and Builders Vision and all these large family office conglomerates that control trillions of dollars, and I think it's about accessing them. They have a lot of flexibility. It's about accessing them in a disciplined way, trying to figure out these are the types of risks that we need solving for, and this is how you guys can help. The last thing I'll say is, I think the non-dilutive capital and concessionary capital is not so concessionary. In the end, if you are a startup and you have a project pipeline of X, however many, the first few projects you should be losing money on, because that's where you learn. And with every milestone individual in those projects, you create a ton of value in your topco, right? So all these folks that require warrant coverages and equity exposure, et cetera, like that's really where it's at. I think if investors are focused on making money on individual projects, it becomes very difficult to achieve anything. And that's where some of this concessionary money can be very helpful.
What about, so, when we look particularly in, what is happening in Europe, no? I mean, we have the Clean Industrial Deal, we have, policies that are changing and shaping, regulatory frameworks, and we have the EIB with a more prominent role, talking about guarantees, talking about, how we can, lower the path for, more private capital to flow in. How do you see the context of the Clean Industrial Deal and, Europe as a whole into what it is happening on the global scale? Is there opportunity for yourself as an investor to look into to deploying first of a kind or even investing in companies here, or how do you see as well that changing? Christian?
Yeah. So I think Europe has a moment now, probably 9-12 months, where you can attract talent, you can attract capital, all those things, right? We invest, for disclaimer, both in North America, outside in the world, and Europe. So we're not from that perspective like pro-Europe, but I think there's a huge opportunity on Europe, and also globalizing more the venture capital industry as such, and also growth investing in climate and energy. So I think that is a huge opportunity right now, short term, which we should grasp, right? I think it's all about the mindset. If we don't change the mindset and the culture and create a bigger cohort of like brilliant entrepreneurs, which we are starting to see in Europe, we will never succeed, even independent of how much capital is coming here, right? And you have to remember, there's lots of money. There's actually lots of people in Europe.
So with that, the money is there. So it is a question as well of changing the mindset. Population is coming, of course, but it is coming always behind. With that, I will leave the room for a couple of questions from the audience. And we would love if there is a chance to hear from funders that are actually looking for raising, either if it's non-dilutive or dilutive capital, and would like to pose a question or share their experience. No one? Well, so with that then, I will jump. So I would like to get a lightning round from you guys. I mean, in today's market, we would like to hear what would be your one piece of advice for funders that are trying to secure non-dilutive capital. Rachel, we start with you.
Sure. It's not new advice. The true thing that has stayed true is you just have to build a good business. And so work, be a talented team in a big market on the path to unit economics that work. And so the advice is you have to have your fundamentals be good fundamentals. And I think sometimes how we end up in a bad spot is we lose track of that in the hype cycles. And then that sort of, then you get a backlash. And on top of those good fundamentals, you do have to do the work to be at that right risk-reward spot in the capital stack so that you are going for the right pool of capital. And it needs to work for your company and it needs to work for your investor. So I think remembering both sides of the table have to have benefit.
I will actually go with a couple. One is I think you got to have crystal clarity and maximum level of candor inside the organization. We're talking about brutal honesty, being willing to be able to be challenged on everything, remembering that no banker and no investor is your friend. They're there to make money. And I think that's where your point comes in. Like, you have to have crystal clarity as to how you're going to get there. Be honest about all the challenges, all the bad things will happen, and be honest with yourself first, because people get found out quicker than everyone gets found out quicker than they expect. So I think that's probably really the key. And also, like, think prospectively and plan. How much capital will you need? What are the contingencies? Ask for advice, things like that.
Ask for advice, Christian.
Yeah, so +1 on building a great business. That's always rule number one. And then secondly, I think plan well ahead, right? Like, some of these things, like, we have to just recognize it takes longer time. When you want to submit, a application for this, it's longer. It takes more time. It's just like prepare. So don't come last minute like, oh shoot, we need non-dilutive financing because X, Y, Z. Like, you have to start like really early thinking this through your business plan and get out there, get to know the right people. And I think that's part of creating product market fit between non-dilutive financing and the companies and great, brilliant entrepreneurs out there.
Great. So thank you, the three of you. I think today we pretty much reminded that it is not about either or. I mean, the non-dilutive capital has worked hand in hand with equity to be able to strongly support the companies throughout the scale phase. We pretty much hear it, like the capital is there. I mean, the three of you mentioned that. So the challenge is pretty much about how to structure it in the right way to matching those risks and creating the momentum to bring those best ideas to market, right? It is about the business case and the bright idea behind. On the Europe side, I must say that we've seen real world progress, that we were reflecting on, the different institutions that are as well at this event and the Energy Tech Summit, like the EU Catalyst Partnership, that it is, helping on structuring how first of a kind can, deploy and ramp up and do those risks. But the EIB venture debt products, or even the clean tech guarantee products, that are actually supporting the wind packets, and they are looking as well to support throughout, the clean tech value chain. But as well, grant-based programs like in Europe, we have the innovation fund that it is as well supporting, that capex up from necessity. So let's not forget, in clean tech for Europe, we estimate that are roughly 38 trillion of euros on the private sector that is available. It might be available to invest in the energy transition right now as we speak, right? So it is a matter of how do we structure those channels to deploy it and to invest it, right? So my one piece of reflection from today to the audience could be that let's not let the noise stop you from hearing the music, right? The opportunity is real, and it is pretty much to us to build, the regulatory frameworks that can enable, that capital flowing and fueling the manufacturers, the solutions and the technologies we need for a net zero economy. So thank you for the three of you, and thank you for the audience to be with us.
And when you say the 28, trillion, it just triggers me. Go out there. If the guys you're asking, like especially the public sector, are not moving fast enough, tell them, I need this tomorrow, right? Tell them the story, sell it, right? Because like that is really the problem. Like we're sitting back there waiting. Like when you're telling me it's 28 trillion, I'm like, why are those money not out there, right? We're moving too slow, especially in Europe.
We're moving too slow. Any final reflection?
I want to add one
Please.
thing, actually. Sorry, but one thing that I would advise folks to think about is ERM, Enterprise Risk Management. Take a page out of any public company profile. Go to an investor with an ERM mindset. We're talking about reporting. We're talking about risk management. We're talking about communication. You go to any investor, including non-dilutive investors, with that kind of approach, and they will find it incredibly refreshing, I assure you. When you have a company that doesn't necessarily have the framework necessarily in place, but a focus on developing that over time and a timeline and plan to do so.
Yeah, I do think, what's the old truism, never let a crisis go to waste. There's a lot that is changing right now, and that means there is a lot of opportunity. I mean, there are, new ways of looking at what's going on in Europe, new ways of thinking about where you're going to get capital from, new ways of framing the opportunity for your company. It is, people do not like chaos and uncertainty, so it feels like a challenging time, but sort of look through that feeling and see the opportunity that is happening from the uncertainty and change.
Thank you very much for the three of you for the good recommendations and the good energy. And thank you for everyone for listening to our panel. Let's join me on a round of applause for our panelists, please.